Okay, class, welcome to Chapter 1 for MBA 500F. Chapter 1, we're going to deal with goals and governance of the corporation. These are the topics covered in Chapter 1. I'll cover some of the important ones here. Of course, investment and financial decisions. We're going to turn to what is a corporation. Most of you probably understand what a corporation is because you've dealt with them in your personal life. You probably work for a corporation. Who is the financial manager? Goals of the corporation. We're going to spend a lot of time on the agency problem. Talk a little bit about executive compensation and corporate governance. I'm not going to cover too much careers in finance. Please review that in the textbook and review upcoming attractions. And I would say please review the snippets of financial history. Give you a little bit of history of finance. Okay, for MBA 500F, we're not going to spend a lot of time with capital budgeting decisions. We'll touch it a little bit. If you decide to take further courses such as MBA 505, you'll spend quite a bit of time on capital budgeting decisions, but we'll touch on it here a little bit. Of course, this is going to be the decision to invest in tangible or intangible assets. For example, American Airlines investing in new planes. This would be a tangible assets. Of course, tangible assets are things that you can touch and kick. And intangible assets would be research and development, R&D, such as Labadabs would be a good example. Okay, the textbook gives you an example, pretty much what I gave you in the last slide there. Tangible asset would be Southwest Airlines, purchasing new planes. Intangible would be a large pharmaceutical, again, investing in R&D, which is very important when we talk about the drug manufacturers. They have to spend a lot of time and money and effort in R&D to come up with new drugs. Out of 10, you may only have, it might even be higher than that. But anyway, for example, out of 10, you may just have one winner, which means that one has to pay for all the R&D cost and also all the cost to manufacture that winner plus the production and sales of that particular drug. Okay, we'll look at financial decisions. Many of you have your own personal financial decisions. Corporations also have financial decisions. Decisions on the sources of amounts of financing. So in other words, if we have a project, we're going to have to, let's go to the capital structure of how are we going to come up with the money. There's many different methods to come up with money. You could use retained earnings, which is money that could either go to stockholders as a dividend or profits turning back into the company for the new project or whatever capital expenditure that you're looking for. Or they could come up with some type of debt, long-term debt, could be like bonds. Or they could borrow money from a bank, insurance company. Or they could decide to do equity financing, which is issuing new stock. Again, here's an illustration of what I discussed in the last slide there. You have debt, equity, goes into the firm and then to the asset. Now, we will get into debt financing here. A major concern of stockholders here is the more debt that the company has is the more risk that's involved. This is money that has to be paid back. If not, the company could be forced into bankruptcy. Also, the more debt that someone has, the investor that's going to buy the bond is going to require a higher rate of return. And if they're borrowing from a bank, the bank, if the company has a lot of debt, it's going to require a larger interest rate. Equity is a popular route also, but what you're doing is when you issue new stock is you're diluting the shares for the other stockholders here. So you have to take in concern. We'll hit that part in this chapter with the agency problem. Okay, then you have different types of assets here. Real assets, assets used to produce goods and services. And then there's the financial assets. That's financial claims to income generated by the firm's real assets. An example of a financial asset would be the stock purchased by an investor or a bond. And that would be the interest rate paid by the company that issued the bond. Here are some examples of capital budgeting or financial decisions. As you can see, companies make large outflows for projects. For example, I'm not going to read all these here for you, but Intel decides to spend $7 billion to develop a new microprocessor. Or Pfizer issues new shares to buy a small biotech company, and anywhere in between here. Companies are making many capital budgeting or financial decisions. And of course, these are going to be financial managers that are going to do that. Now, usually you're going to think that the financial manager is only a person in the finance department, but you'll be having people make financial decisions that are in production, marketing, information system, and they'll partner with the finance department when making those decisions. Okay, let's turn to what a corporation is, as stated in the beginning of this lecture here. Most of us either work for a corporation, have done business with corporations. Of course, a business organization is a separate legal entity owned by stockholders. Now, in this country, the corporations are set up by states. Of course, you can have a public company. A public company is going to be one that's listed on the stock exchange that you can purchase and sell their stocks. Private corporations will still have stock issued, but you won't have the secondary market to sell your securities to. So if you wanted to sell your stock with a private corporation, you would have to find the buyer yourself. Of course, there's the limited liability corporation is another form or type of corporation. Okay, let's talk about the types of business organizations. Again, most people here have dealt with all of these. Sole proprietorship is someone who owns the company. They're usually the owner or manager. That might be a local small pizza shop that you purchase your pizza from would be an example. Partnership is a group of individuals that come together that has some type of expertise and they run the company. Of course, you can have a general partner, and then there's also a limited partnership, which they're limited only to what they invest into the partnership. Now, both of these, sole proprietor and partnerships, if you lose money, they can come after your personal assets. Of course, there's the corporation, which we just talked about, and you can have a limited liability partnership or a limited liability corporation, or a lot of your doctors and accountants here have their professional corporation. With limited liability, the owners of the corporations are not personally liable for its obligations. So in other words, if I purchase stock in Ford Corporation and someone is suing them, or they're not paying their bills, we'll say on their bonds or their bank loan, the debtor cannot come against me personally with my private assets. The only thing I could lose would be the value of the stock that I purchased the Ford Corporation for. And here's just a figure of basically what I said in the last slide here. You can see the different forms of organizations or businesses, sole proprietor all the way to the corporation. Of course, who owns the business with the sole proprietorship? Of course, that'd be the manager. In the partnership would be the partners, and in the corporation would be the corporation. Like I said, I'm not going to go through all this because I covered this information in the last slide, but it just gives you a visual of the different forms of organizations that are out there. Okay, let's look at a little bit of taxation and the liability, which I was also talked in the prior slide. With the sole proprietorship and partnerships, you're going to have an unlimited liability. So if you don't pay your bank loan, they can come after your personal assets, such as your house, pension, things like that. Of course, on taxation, personal tax on the profits from the corporation. So you're going to use a Schedule C with these two forms here. The corporation, it's limited liability, corporate tax on profits, and then you could also pay tax on personal tax on dividends. Of course, there are some tax advantages on dividends here, and we'll talk about that when we hit the stock part in this corporation. Okay, let's turn to who are the financial managers. As I stated before, I say that there's many other people that make financial decisions, but these are your, I would say, your main or your finance department side who's going to be either making the decision or making it jointly with other sections, such as with production or marketing, things like that. If they're, or let's say information system, if they're going to come, if the company wants to purchase a new computer system here, it's going to be decision makers are going to be, of course, the finance side of it, but also it'd be the information system side that's going to come up with a conclusion of if they're going to purchase a new system. Of course, here you have your chief financial officer, treasurer, and controller. Of course, your chief financial officer is going to supervise all financial functions, do the strategy, goals, all that. Your treasurer is responsible for financing, cash management, relations with the banks and other financial institutions. And your controller is more of the accounting side of this finance department here, responsible for budgeting, accounting, and taxes. Okay, let's turn to the flow or the cash flow of funds through a company. Let's start with the investors. One, they're going to send money to the corporation, and here the financial managers are going to decide and direct money. And that money is going to go with the firm's operations, your raw assets. So cash invested in the firm here. Number 3, here's cash generated by the operation, and that's going to come back to the financial managers, and then they have two decisions here. They can either reinvest, which we call that retained earnings, back into the company, and that can be used for future operations and future projects. And if there's a lot of retained earnings, then maybe the company does not have to go to a third party, such as issuing new stock or issuing bonds or borrowing money from a company for future projects. Or what most investors would like, they would like to receive some type of cash return, which would be the cash dividend. Okay, continue on with goals of the corporation. Of course, that would be maximize the wealth for the shareholders. Of course, they want more profits with stock prices going up. So if they sell their stock, they'll receive capital gains, or receiving dividends, which will help with their return on their investment. Of course, there's the opportunity cost of capital. The minimal acceptable rate of return on capital investment set by investment opportunities available to shareholders in the financial markets. So if your shareholders can earn more money from your profits from your company, then the financial managers should send it to them. If the company itself can earn a higher return, then maybe the company should keep that. The benefit of keeping or returning money, which we call retained earnings, back into the corporation is that the stockholders are going to see an increase in stock prices and hopefully a future increase in dividends down the road. And here is just a visual of what I've discussed in the last slide here. You have what cash the firm can either invest that into investment opportunities and different types of projects that's going to be real assets for it, or they can send it to the shareholders and then they can invest that money into the investment opportunities that they have.